Here's how our portfolios are positioned here at Middlefield. Again, not surprisingly, our three largest weightings, about 2/3 of the fund is in industrial REITs, multifamily REITs, and brick and mortar grocery anchored retail REITs. And then we've got exposure to various other areas, including healthcare REITs, as well as we own some real estate services businesses who are in the brokerage area or the property management area. The next few slides just talk about some of our favorite names in these areas. So beginning with industrial, we talked about the demand drive for, just in case as opposed to just in time, onshoring of manufacturing activity. We talk about continued growth in e-commerce. We talk about the releasing spreads. So in Q1 of this year, industrial REITs in Canada were able to renew those leases in Q1 that came due by almost 30%. Just shows you this imbalance between demand and supply. And some of the companies that we think are really benefiting from that, Granite REIT, which is our largest industrial REIT in Canada with most of its exposure in the US, but also Canadian exposure as well as in Europe. And then Prologis REIT, which is a US industrial REIT. In fact, Prologis is the largest REIT in the world, so by definition, it's the largest industrial REIT in the world as well, and continues to do very well because of those supply-demand imbalances. On the apartment or multifamily side, again, growth in immigration, single-family homes being out of reach for most Canadians. We think this will continue to drive demand for apartments. We like a company like Boardwalk, whose assets are primarily located in Alberta, where you don't have rent control, whereas in Ontario, we do have rent control, so we like that. And I just read a report on Boardwalk over the last few days and, renewing its leases at 8 or 10% higher than the leases that were in place. So again, showing you how powerful the demand is and how limited the supply is for, new apartments. CAPREIT is by far the largest multifamily REIT in Canada. As you can see, it's got nearly 70,000 suites, both in Canada and in Europe. And basically showing you that, the average rent that it's enjoying today at about $1,300 to $1,500 a month is well below current market rents. So as its portfolio turns over, i.e. tenants vacate, new tenants come in, it will be able to participate in this growth as a result of those higher market rates. On the retail side, again, this might surprise some people, but our grocery anchored open air retail REITs are doing very well. They've been able to really transition their businesses over the last 8 or 10 years. They're not adding new power centers anchored by a Walmart or a Loblaws, and they've also done a good job in cleaning up their portfolio through the 08-09 financial crisis and then more recently through the pandemic. So they're really well positioned today. Case in point, we had Bed Bath & Beyond go bankrupt in the US earlier this year. They had about 65 locations in the Canadian market. Most of those were in our open air grocery anchored REITs like RioCan and Choice Properties. All of those 65 locations have since been released, and in many cases at a higher rate than Bed Bath & Beyond was paying prior. So it just shows you the demand and the limited supply in this market. The other thing that's driving some growth in our brick and mortar retail REITs is that they've come to realize over the last 10 years that they've got these massive land banks surrounding their properties, most of which are just huge parking lots. And those parking lots are now being redeveloped into higher value uses, whether that's new apartment rental buildings, condominiums, or self-storage. All of those are just adding additional income to these retail REIT portfolios. On the digital side, again, we talked about the cell towers and the data centers. Again, not surprising to anybody that, there is an explosion in data, and I think that's going to be really exacerbated by this growth in AI, as well as the number of smartphone users continuing to grow annually all around the world. That's going to create incremental demand for the data storage that you're finding within the data centers, as well as cell towers who are basically transmitting data. So we continue to have exposure to this market. Two of our favorite names here would be Equinix, which is one of the largest data center REITs, as well as SBA Communications, who is a leading player in the cell tower REITs. On the healthcare side, This sector really had a very rough go during the pandemic, whether you were running a long-term care home, whether you were running a retirement home, major challenges, which particularly impacted seniors and as a result, senior care facilities. We think most of those challenges are now behind them, and they're now squarely focused on increasing their occupancy. That's already happened in the US, and you're now starting to see it happen in Canada. So one of our favorite names here is Chartwell in Canada, which has now finally got its occupancy back up to about 80%. And we think that's going to continue to grow very gradually over the coming months at very attractive rental rates. So we think it's really well positioned. So we think the worst is behind this sector now that the pandemic and the worst of the pandemic is behind us.